This is our Forex blog for May 7th, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. A lot of traders, are always told, and you read, you want to trade with the trend. But what time frame trend do you want to trade with? As you can see today, the real-time trend of the dollar, for the most part, was down. The percentage of currencies on the 15-minute trend that shifted down even before midnight was very high. And then the hourly trend shifted down at 6. The daily trend, weekly trend, and monthly trend were up all day because of how strong it was last week. And the daily trend really started to shift down at 10:30. So trends change first in real time, and then the longer the time frame, the longer it takes for those trends to change. So what time frame trend do you want to trade with? Well, if you're an intraday trader like ourselves, and you see real-time weakness in the dollar and the yen, if the percentage of currencies trending down on the 15-minute chart is pretty high like this, you can trade that currency, even though the longer-term trend is up. Now, because the longer-term trend is up, you have to be aware that this downtrend could last for an hour to 3 hours, maybe 5 hours, or, as in today's case, all day. But be cautioned and be very cautious if the longer-term trend is up, because a lot of times you have a downtrend for a few hours and then you have a lot of strength come in and it resumes the direction of the weekly and monthly trend, and oftentimes the daily trend. So that being the case, you can clearly see the daily trend of the yen switch down around 6. If you traded the U.S. session, you would have been better off. It's safer to trade the much weaker yen than the dollar. But nonetheless, these are both weak, so you want to trade the strongest ones today against it. The Australian was showing a counter trend move today. The real-time trend, the 15-minute trend, the hourly trend shifted up. The daily trend shifted up relatively earlier, actually even last night. So buying the Australian dollar, buying the Australian yen makes sense. The euro had incredible strength coming up to today and starting the day off. The percentage of currencies trending up is very high. And this is one of the reasons why my latest currency meter that I give our traders has these two color strips underneath it. Because if you just looked at the daily, weekly, monthly trend, you may not have the confidence to buy the euro. Trends change. You can have a trend that lasts for a day to even a few months, and then when the trend changes, you first spot it in the real time, and then the 15, then the hourly, then the daily, then the weekly, then the monthly, the vast majority of the times. So buying the euro dollar today, buying the euro yen, buying the Australian dollar, buying the Australian yen. So let's start with the euro, because a lot of people like to trade that one. This currency, first of all, gapped down on Sunday, probably due to the socialists winning in France. And once it kind of went down and kind of went sideways, notice our 3.0 green band. It's almost extremely rare for currencies to go underneath that level and not reverse, usually within half an hour. But due to the gap on Sunday, it takes the hourly moving average a little bit of time to catch up to price. Only on big gaps are you ever going to see that. But nonetheless, on Sunday that happened. And today, when the euro started having strength, basically you're looking to buy breakouts down here, this multi-hour range. This is kind of a wedge pattern of volatility that once a trend is down and you start having lower and lower and lower volatility like this, breakouts tend to be profitable. Plus, once you find a strong trend like that, looking for a 3 to 5 bar pullback with one bar going back in the direction of the trend. In other words, this is a trend that's going up. You have a multi-bar pullback right here, red bar, red bar, red bar, 3 to 8 red bars in a row. The first green bar, you want to buy it when it goes 1 pip above here. Let's say at 3,000, and notice it went up to 23. So that's 23 pips. That's almost 2 days minimum net profit that we look for. You have another pullback right here, 3 bar pullback in green. I am working on automated systems that will showcase these type of trades in real time, along with trailing stops to get you out. I'll add this to the chart. You can see that it gave those buy signals right there. See, green, up, green. This one kind of chopped around a little bit. Ultimately, it did go up on the next wave. And a lot of times when these show up on your chart, If the trade doesn't work and you get another pullback down and it can't break that low, you really want to buy it again right here. You might have got in this trade, or you might still have been in that trade, or you might have gotten out with a small 5-pip loss. When it breaks out again, you want to get in. You don't want to miss the potential of a 20 or 30 pip win just because you got out with a small 5 or 6 pip loss first. This is a tool that I'm developing to be used in an automated system, but you can see it's pretty good at picking entries. This is the same chart without all the other indicators on it. It makes it clearer, easier to see. Nice little pullback here. This one, this one, this one, this one here failed. Small win, small 20, 30 pip win on that one. Now let's go to a different currency, and I want to show how sometimes if the first signal doesn't generate a move and the market continues to make a counter trend move, a lot of times the second entry is within 1 or 2 bars away. So we're going to scroll back and look at this on the Here's a good example of that. You got your 3-bar pullback, your 1 green bar, and we're really looking to buy when it goes above that bar's high. And sometimes the market isn't done pulling back enough before it starts to resume that trend. So if we have a 3-bar pullback with 1 counter trend bar up and it doesn't break out in that direction, the next time the market flips back up to green, you want to buy it when it goes above the previous bar's high by 1 pip, so that'd be at 1.0337. Now this trade really didn't lead to any massive profits, but it did go from 37 all the way up to 45. More than enough to move your stop to break even, or if you're watching this doesn't have any of our real-time tools on there. If you saw it going up with very low statistical momentum, then you might get out of this trade with a 3 to 5 pip win versus a loss. Here's the same pattern on the pound dollar today. Now, I don't think the pound was quite as strong as the euro. However, that being said, when you get these signals, and most of the time they do lead to at least a 5 or 10 pip move in your direction. You can see the signal right here generated 6 or 8 pips. This pullback right here went from around 40 all the way up to 70. Beautiful 30 pip move. This pullback right here went from 50 all the way up to 90, another 40 pip move. So, when the trades don't work, let's say as this trade right here, if you bought it when it went above this bar's high, you lose, 6 to 10 pips. Once it starts going up, you move your stop up, more likely you lost 6, 7 pips on this one. This trade here maybe made 10 pips, maybe you made 5 pips here, 20 or 30 pips, 40 pips. And having bigger wins than losses is really the key to trading. Now, the pound didn't quite have the same kind of intensity the euro did today. However, unlike the euro, the pound's daily, weekly, monthly trend is up, and at least starting the day off, the peaks of strength were more than the pullback. Anytime you see a lot of strength going up followed by very little weakness, usually that momentum continues. So you had that here and here, barely here, this is about even, and this was the first sign that the uptrend is likely to be over because the strength was just a little bit more than the weakness, and then the next move up didn't have that much intensity, so the previous weakness is likely to continue. Now, when the pound got weak like this, you went and traded against the super weak dollar or yen, but the pound, right around 7 right here, you might have traded it against the super strong euro today. So here's the euro pound chart coming up to 730 right here, and you can see it went from 60 all the way up to 80. This one kind of went up, sideways. These are some of the patterns you want to look for once you see a trend. This is in our range chart because I didn't leave this one running overnight, but whoops. It does have a nice little wedge pattern right here. And if you can spot wedge patterns on charts in the direction of the trend, the breakouts tend to be pretty effective. They work more often than they don't, and the Fibonacci profit targets are great places to get out of trades at. I'd like to end this blog video with one other lesson, and that is when you find a trend and you spot a little tiny rectangle pattern on your chart, like for instance right here, and I'm still working on trying to perfect a mathematical way of finding these trades on the chart. These are all ones I would consider to be rectangle patterns. And a lot of times they show up, especially after a news event, explosive move, and then the market's kind of chopping up and down. They typically have a high minus low of 10 pips, less than 10 pips, less than 10 pips. And usually breakouts in this direction tend to lead to some nice moves. Now this one only went up 10 pips. This one was kind of chopping around. If you bought that breakout right here, more than likely you lost. This one went up 10, 15 pips, and it's just kind of going sideways again right now. But the point is, anytime you see a big move followed by one of these patterns, typically it's a pretty decent place for looking for re-entries. This is a better example of that. The Australian dollar started to trend up today. So you're really kind of using our currency meter to spot the right currencies. We know that the Australian was strong today and the dollar and the yen were weak. You have that little pattern right here where it went up and went sideways. When it breaks out, you can see it went from around 61 all the way up to 98. Nice 40 pip move. And if you miss that move, you also have a nice little one right here as well. So anytime you see a strongly trending currency where there's no pullbacks whatsoever, if you waited for a 3-bar pullback on this, you really only had one right here. 1, 2, 3, followed by the green bar. You would have been in this trade right here at 84 based on our 3+ bar pullback method that I just went over earlier. But a lot of these, when you see these ranges like this, here you only have a 2-bar pullback. Here the market went up, down, up, down, up, up, down, up, down, up, down, up, down. And that's one of the things that this pattern's, looking for mathematically. These breakouts tend to work, and you also have the benefit of, when you're manually trading, of drawing your fibs on the chart and exiting at the Fibonacci profit target. The key is small losses and much bigger wins. As you can see, this market kind of went right to the 1.618, almost to the pip. So if you had bought this breakout right here at 72, you're out at 97. Beautiful 25+ pip move while risking less than 10 pips. And again, that's the key to trading. Small losses, bigger wins, and using the currency meter and focusing on being in the currencies that are most strongly trending. They're more likely to continue trending as long as you watch those once you get into the trade. If the trend comes back, stay with it. If it doesn't, get out with a small loss or even 3 to 8 pip win sometimes.